I think we got to start with the future. Surprise is kind of muted. I mean, Chinese equities we can see are higher right now when we're looking at those at the ETFs. Are you surprised not to see U.S. stocks down a little bit, kind of muted?
I think a lot of it is factored in. I think from this point onwards, this is actually a very positive development because as we start to get more certainty about the tariff negotiations, that puts the Fed in a position to start cutting rates again, which we think will actually be good for the market as well as the economy.
All right, so you lead me to my next question. I got a lot of questions about the Fed, but I'm going to get to those in a second. Over the last week, the best performing sector has actually been energy. I would imagine some of that is on the idea that manufacturing is going to ramp up here in the U.S. and in China when some of this tariff uncertainty goes away. Chips have outperformed even energy, up 4%. If you're looking to put some money to work, where would it be? Do you see the opportunities in one of those areas, or is there another area that you think is kind of like a second-tier beneficiary as these talks continue?
We do like energy, especially because as Trump scales back some of Biden's clean energy policies, I think some of oil-related companies, they will benefit. But what we are advising clients is that this is going to be a very volatile environment in the market. So keep your exposure broad. Have exposure to utilities, consumer staples, financials, energy. Don't be concentrated at any sectors. And gold, Frank, has been a tremendous play in our portfolios this year. It's up more than 25%. So our clients have fared really well because of that.
You know, it's really interesting that you're talking about going into defensive sectors like utilities and staples, but I want to look ahead to today's CPI. Expected to see an uptick for core and for headline. I was talking to the chief investment strategist of a big bank. They said this report, you know, it doesn't have that much weight to it, but if you see a trend, maybe 2 months, 3 months of inflation ticking back up, that would change their view of the market. Right now, they like consumer discretionary, actually, especially on the back of those U.S.-China trade talks. If this is the start of a trend, right now, 1 month's supposed to tick up, but if it's the start of a trend, how does it change your view of the market or shape it?
Well, if inflation continues to go higher, that means that the Fed is going to pause for a while, and that may not be too good for the market. But we do feel that over the course of the next few months, we will start to see the more certainty as far as it comes to tariffs. And we do think that AI-driven productivity increase will actually be a deflationary factor on the market. So eventually, we do think that the Fed comes back into play starting September, and we likely get 2 rate cuts this year.
If you're this defensive, because you're saying you need to put some money in utilities and also staples, what do you think about bonds, whether they're corporates or treasuries?
I think bonds play a role in a client's portfolio. You definitely want to have bonds. We also want to have international in the portfolio as well.
Still?
Yes, definitely, because the international markets have tremendously underperformed the U.S. markets in the financial crisis.
That's a little vague, though, Aadil. So give us one market, whether it's Germany, the DAX. I mean, give us one that you're seeing a lot of opportunity in.
So we do like the exposure to the Chinese market. You know, we do think some of the emerging markets like India will do well. We do want to have exposure in these type of areas because we think that, especially if the dollar becomes potentially weaker from a relative valuation point of view, these markets will appreciate.